Market breadth is looking slightly shaky, and that is a worrisome part. So it's not that Nifty is giving in. We're actually doing better than what US markets did last night, but the market breadth is getting crunched. Risk is no longer a phenomenon which traders are chasing. The momentum of the market, which markets enjoyed in early part of Jan, early part of Feb, that momentum is shaking. And most of the market participants, they always trade price. So the near-term direction is telling you that if you have followed this very simple strategy of chasing stocks or buying stocks on every decline, that strategy may not be a very payoff strategy in the short term. And the endorsement from Rakesh Jhunjhunwala that markets are not headed anywhere, these are typical telltale signs that right now you need to be cognizant of risk. Let the market digest some gains. When earnings they stabilize, things could again pick up in terms of price action and market activity. So let's do a ground check of demand and where the Indian organized retail sector is headed. And to do that, I have with me Mr. Kulin Lalbhai, Executive Director with Arvind Limited. Kulin, good morning and thank you for joining us. Kulin, first let's look at the demand scenario. What is your understanding of the way how demand trends are shaping up for the organized retail market? Because depending on whom you're asking, you're getting a different answer, because each brand is not growing at the same rate. There's a huge divergence which is now visible in the organized retail market.
Yes, I think the domestic demand is, I would say, settling down. I think we had a period post GST where the market was, soft. I think demand took a little bit of time to recover. So I would say that the demand is just about coming back. I think the medium-term view, though, is that the demand side should be quite strong as far as the branded apparel segment is concerned. Now, when you look at the overall market, there are segments of it which are definitely growing faster. One of the segments which is seeing a lot of traction is what we call the value retail segment, which is, apparel at a price of less than 1,000 rupees. And this is where there is a shift happening from the unorganized to the organized market. And I think this shift will further accelerate in a post-GST world. So that's where I would say there is the strongest traction at the moment. And for the rest of the market, it is just about coming back to normal.
Could you give me a sense of what is happening to your in-house brands in terms of growth, and what is happening with some of your key global licensed brands?
We have been seeing a strong growth in our branded apparel business. In fact, for this particular fiscal year, we will have a growth of close to 20%. So it's a strong growth, and we believe that the organized branded apparel market is going to see structurally a very strong growth curve over the next 5 years, because fundamentally, there is a huge shift happening towards the branded segment, and India still is very unsaturated when it comes to, the apparel buying. So as disposable incomes go up, you will see not only, more and more cities supporting retail stores. You've got channels such as online providing a huge new market for branded apparel. And you've got new categories which are emerging continuously. So Arvind has a very strong platform. We have more than 15 brands which are scaling rapidly. And we have a 5-year vision of our branded apparel business reaching a turnover of 9,000 crores. So that is on the back of, category expansion, channel expansion, as well as the new brands which the group has taken on, which are scaling up rapidly. So we believe that the 20+% growth will remain in this segment for the next 5 years.
Kulin, hi, morning. Tell me about the store profitability and the level of same-store sales growth that you've been delivering in the last 9 months. And also, what is the additional store count that you're aiming for the next 2 to 3 years?
So our same-store sales growth have been at a healthy, 7 to 8%. There was obviously a quarter where same-store sales growth got affected around GST. But we have come back to, our normal kind of guideline of a 7-8% same-store growth. On the value side, the same-store growth has been higher. It's been in the double digits. And as a group, we tend to open close to 200 stores every year across all of our different brands.
More than 70% of your brands are located within 5 minutes drive of each other. What are the costs that you're saving in real estate rentals on the back of this cluster approach?
So one of the strengths of Arvind is we have a very strong platform, and the platform allows us very, very strategic relationships on the distribution side, which means, whether it is a mall or whether it is a department store or whether it's an online portal, since the company, would tend to sign up more than 15 properties or 15 brands with each of these channels, we can have a very strategic relationship with them. This allows, better locations, obviously favorable commercial terms. So it's a win-win relationship that we have, and every brand which is a part of our platform gets the benefit of Arvind's distribution strength. So this does allow us to scale up the business profitably.
You just led me, Kulin, to my next question. While you do have 8 brands which are contributing more than 100 crore rupees in terms of sales, there are also brands that you have in your umbrella like Gap, Nautica, etc., which have been struggling in the Indian market. Are you relooking at your strategy to boost their sales? And by when can we see things turning around?
In fact, both our specialty retail, which is our big box retail, and our bridge to luxury is scaling up well. In fact, in the next year, we will see a very strong pivot in profitability in what we call our emerging brands. Because in our business, when you cross, a turnover of 100, 150 crores in a brand, suddenly the operating leverage kicks in. And you see a very large increase in profitability. So some of the brands which were mentioned were brands which have been added to the portfolio in the last few years, and we're going to see them cross that mark which I mentioned next year and the year after next. So that's one of the areas where one will see a strong change in profitability. In fact, as a portfolio, we will increase our bottom line by 175 basis points or so this fiscal. And we are confident in achieving 150 basis points increase every year. And the reason that is that, our entire portfolio is approaching what we call maturity, which is brands crossing, the triple-digit mark and achieving scale and operating leverage. So we are quite excited about the growth potential of some of these brands because they are relatively much less saturated and they have a very long runway of growth ahead of them.
Kulin, now, I'm a great admirer of your NN Now portal and must also, acknowledge that I'm a big customer there. What I want to understand is that one side you've got these licensed brands which you're selling in retail outlets. Some of those brands are again being sold as the online mode. Now, the millennials like these brands, but in terms of pricing, there's a big disparity which is available. So how will things really settle for your global licensed brand business?
See, the way we like to look at the world is the world of tomorrow is going to kind of become seamless between online and offline. You should not think of these two channels differently. And as brand owners, we care equally about both. Because in an omni-channel world, consumers will make purchase decisions both online and offline. And if we can bring, seamlessness on that decision making, that's when brands will truly be able to deliver delight to the customers. So, for example, in many mature markets, a lot of buying decisions are happening online. 60% of decisions are made online, even though 90% of the sales are offline. So for our brands, it is critical to, be on the palm of the millennials' hands on their smartphones, because that's where they will be making their decisions. And as the channels all kind of hit an equilibrium and balance, you will see that, even on the pricing side, things will settle down. We are in a phase where new channels are emerging at a rapid pace, and there are temporary imbalances. But the idea is that over time, pricing across channels for a similar product would never be different. Obviously, older season stock would always be available on liquidation, whether it is in factory outlets, offline or online. But for fresh goods, the latest season and the latest fashion, both the online and offline experiences have to completely converge. And we are very big believers in omni-channel, which is why we are enabling platforms which allow online-offline journeys, where you can open up the inventory of a store on the app and shortlist products which you will go and pick up from store. So this is the world of the future. And Arvind is making the investments required on the technology backbone to allow these seamless experiences to be delivered to the customers.
Where do you think your basic bread and butter business, which is the textile business, headed? Because the aggregate picture looks muted when we look at the combined picture of all the businesses, and that's the reason why I think you're demerging the company. But independently, if you have to share what's happening in the textile business with this entire China slowdown, how are things moving there?
So we are very excited about our textile business because two macro global trends, have made the future very exciting. One, definitely, as you said, China dominates the trade. 35% of global trade is with China, 5% is with India. And China is very quickly losing competitiveness, and we see the supply chain moving very quickly towards South Asia. And the other big trend is the domestic market, because as the branded apparel market grows, it's organized textile players that are going to service that very large, rapidly growing market. So Arvind is getting back into a strong capex cycle as far as its textile business is concerned. So we'll be investing around 1,500 crores over the next 3 years along 4 key themes. The one theme is what we call verticalization, which is that as the world moves towards fast fashion, brands want to buy end-to-end solutions. They want to buy garments and not fabrics. So today only 10% of our fabrics are converted into garments. We're going to take that number up to 30-40% over the next 3 years. So there's going to be rapid growth happening on garmenting for Arvind, and that's going to be a global garmenting happening in India and Ethiopia. The second big trend is that we are betting on new verticals. So things like sportswear and athleisure are growing globally at a very rapid pace. These are new segments that the company is not in, so we will be setting up manufacturing capabilities in those segments. The third very exciting area is technical textiles, which is using a textile process for very different end uses, such as protective fabrics, wind energy, infrastructure, construction. That's a huge market that's emerging in India, and we are already the leaders in that space with a 600 crore technical textiles business which is rapidly scaling up. And lastly, we have a branded textile segment where we sell fabrics which are branded under the brand name Arvind in more than 10,000 points of sale across India. And like our fashion business, this segment is seeing rapid growth because it's moving from unorganized to organized. And it's a brand-led play, so it's very exciting. So along these 4 different dimensions, we have put together quite an exciting growth strategy. And you will see the textile business growth, which has been more in the 5 to 6% range, will move to the 10 to 12% revenue per year on the large base that we have. It's a 6,000 crore business for us today, and we see it doubling. As in times moving forward.
Well, good to hear and get such a robust guidance from you. So closing comments, in terms of the timeline, how far are you away from the entire demerger process, and when do you think all the businesses would be listed? Can you give us a broad timeline?
We're expecting that the entire process should be complete around the August-September time frame. It's, the normal process that you need to go through for any sort of demerger of the sort. So we are expecting an August to September sort of timeline for all the businesses to be separately listed.
Colleen, indeed a pleasure to have you on ET Now, and I certainly hope to see much more of you going forward. And thank you for your time. Let's take a break with the news that markets have recovered marginally from the day's low. We are outperforming global markets, but the market breadth is completely dented. I mean, PSU banks have not recovered at all. Bit of a yes and a no there continues. And PNB, I mean, the erosion in market cap for PNB is now nearly $4 billion. So let's take a